Hi, this is Vijay Bamvani and I'm recording this video. Staying indoors, obeying the lockdown instructions and staying safe. I hope you're following suit and keeping yourself and your family firmly indoors and staying safe also. Now the purpose of this video is to keep you abreast, keep you updated about what is happening in the markets right now. I read a news article in a financial newspaper that SEBI, in line with keeping the extended lockdown possibilities in mind, has extended the restrictions on market trades, at least a certain portion of the market trades, till 28th of May 2020. What does it actually mean for you? How does it impact your trading? And what you should, or rather should not be doing. So here are my 2 bits on this subject. Now the restrictions that were imposed in the markets after the lockdown was imposed was short selling was restricted. FIIs, that is foreign investment institutions, FPIs, foreign portfolio investors, were allowed to sell or hedge in the markets in both stocks and headline indices, the Nifty, the Bank Nifty, only to the extent of their investment portfolio. Which means if they were holding shares to the extent of say 1,000 crores, they could not short the Nifty, the Bank Nifty or individual counters more than 1,000 crores. Which means they were allowed a hedge but not naked short sales. Now this restriction is extended till 28th of May. In terms of restrictions on domestic Indian players, also resident Indians, there are restrictions on short sales. Initial margins, also known as PAN margins, are significantly higher, which means to be able to enter a trade now in any direction, long or short, you need to pay higher money upfront, which means trading will now become a capital intensive business. This is done so as to discourage the retail players from playing in the leveraged markets. And as far as delivery based investors are concerned, in certain circumstances, if they wish to sell shares for delivery, they may need to pay margins of 30% to be able to sell their stock. Now, what are those conditions? Supposing you have delivery-based investments which are not lying in the broker's pool account and they're lying in some other demat account elsewhere. In that case, you can sell the shares provided you pay 30% and at the discretion of the broker, even higher if they so wish, before he allows you to sell the shares. Once you deliver the shares to his pool account, along with the payout, you will get your margin back. But which means that playing even in the delivery business, delivery side of the market, is now going to be capital intensive also. You will require more money to be able to conduct the business of investments and trading. To that extent, I feel the turnover in the market can fall. Now you have seen my social media posts, the basis analysis of the Nifty versus the Bank Nifty, the NSE turnover and the stock-wise top 20 movers, statistical beta stocks, stocks that have the highest open interest and highest volume, etc. You're seeing those lists shrink. You're seeing the daily turnover shrink. You're seeing volumes even on expiry days shrink. I expect this procedure to extend. Obviously, since SEBI has extended the restrictions on trading till 28th May, these turnover and other figures will also continue to compress for a while. Which means that the market is likely to see a bigger spread between the bids and the offers, the buyers and the sellers. And whenever the bids and the offers are bigger, the spreads are bigger on these bids and offers, you tend to take home less money for the simple reason that you're paying higher execution costs. It's taking you a bigger chunk of your profit is being taken away by the bid and offer spreads. That will be one problem. The other problem would be the impact cost, the difference between bid number 1, bid number 2, bid number 3 successively. Earlier it could be as low as 5 paise, but you will now possibly see the impact cost rise. So for players who want to play on bigger sums, they might have to shell out more money to be able to have their orders getting filled or executed, because not only the impact cost, not only the bid and offer spreads, but the impact cost, which is the vertical cost. The impact cost is vertical, the spread is horizontal. So your expenses are going to rise both horizontally and vertically. That is a rational assessment of what is happening in the market. Now for the call of action. What should I do? Let me tell you what I would do. I would back off from the market. This is a market where I don't really need to put in too much exposure. I don't really need to risk my neck out excessively. I would prefer to keep the powder dry, and I would like to stick to more cash than open positions. Whenever the market is light, whenever the exposure of traders is light, which it is right now, markets unfortunately tend to behave like a football. Kick it in either direction and it moves exaggeratedly. I don't know about you, but I am not comfortable with the idea of keeping a trade open and the market moving exaggeratedly, possibly against the direction in which I have traded. So if I've gone long, the market moving in a sizable manner in the downward direction, or if I'm short, which I cannot really do effectively because of the SEBI ban. In case I'm short, then the market moves up exaggeratedly. Now, these are nightmares that a trader would like to avoid. So, I would, from my point of view, of course, you can feel free to differ. I would say avoid excessive trading. Avoid trading per se. Stay light, stay safe, conserve money, and focus on staying alive by staying indoors. This is Vijay Bambwani signing off from this video, assuring you of getting you more videos as usual. But before I do, let me remind you to click like on this video if you're watching it on YouTube. In the comment section, do let me know what you think about this video and what else you would want me to record in the future for you. And hey, do not forget to share this video with your family and friends and help me spread the cult of knowledge-based investments and trading. Also, let me remind you, we are on Telegram. You can join Equity Master's Telegram channel with the official handle Equity Master Official. I put up updates out there Monday to Friday, a couple of times a day. See you out there. Take very good care of your investments and trades, as also of your family. Stay indoors. Thank you.
Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.